Albert Einstein famously called compound interest the eighth wonder of the world. And he said, "He who understands it, earns it. He who doesn't, pays it." And most crypto investors are currently paying for it without even realizing it. They're sitting on their crypto bags of XRP, Ethereum, or Bitcoin, either in a centralized exchange or in cold storage, waiting for a moonshot price eventually to hit, changing their lives and their family's life. They are waiting for a single moment in the future while their capital is dying in the present. And institutions like BlackRock and Goldman Sachs, they don't just hold in hope. They understand the Warren Buffett snowball. They activate their assets to earn yield, doubling their holdings while they wait for the price to move. So unlike retail investors that are just sitting on their hands, they're deploying very specific DeFi yield protocols right now behind closed doors. And if you have crypto sitting idle, you are effectively paying what's called the silent tax to the market. So in this video, I'm breaking down the institutional yield blueprint, the exact infrastructure that the top 1% use to generate passive income from their idle crypto so they never have to sell their golden goose back to the banks for worthless paper dollars. Now, here's where most retail investors get it completely wrong, so pay close attention. When they try to earn yield on their idle crypto, they chase the maximum yield protocols. They see something like 40%, 100%, 200%, or even 1,000% APY on a new, unproven protocol, and then they deploy everything without understanding the risks. Then they get wrecked and they call yield generation or liquidity pools a scam when in fact they didn't have a proper strategy to minimize their risk while also maximizing their upsides. Whereas institutions, they do the exact opposite. They optimize for risk-adjusted yield, and they know that a steady 5 to 8% APY across established audited protocols beats a 500% APY moonshot protocol that gets exploited or collapse next week. So here's the difference. Retail chases numbers, institutions, they manage risk. So today I'm showing you the institutional yield generation blueprint, and we're going to be breaking down the specific protocols that institutions actually trust and use right now, the deep dive security filters that you need to use on platforms like DeFi Llama, and then also we're going to discuss the risk rankings, portfolio allocation strategies, tax considerations, and how you can apply this framework to any crypto that you're holding, whether it's Ethereum, Bitcoin, XRP, stable coins like RLUSD, USDC, USDT, or even wrapped Bitcoin. So let's get into it. Comment 777 if you're ready to stop being a spectator and you're ready to start becoming your own bank. If you're going to become the first millionaire in your family tree, confirm it by smashing the subscribe button. Let's run it. All right, bull runners, welcome back to the channel. So before we talk about specific yield protocols, you need to understand why institutions think differently about yield than everyone else. Retail investors, they optimize for maximum APY. They see a new farm offering 80% yield, let's say, and they jump right in. Institutions, what they optimize for is risk-adjusted returns, and they ask, what's the yield relative to the risk that I'm taking? So here's a simplified example. Protocol A offers 40% APY, that's annual percentage yield on your income. So if you have, let's say, $100,000 in that protocol, a 40% APY would be $40,000 in yield on your income. But let's say that protocol has a 50% chance of getting exploited based on its newness and lack of audit. Well, your expected return after accounting for the risk there is actually negative because of the audit exploit, whereas protocol B offers 6% APY with a 2% historical risk of loss based on years of operation and multiple audits from reputable companies. So the expected risk-adjusted return is positive there. Now, institutions are going to choose protocol B every single time, whereas retail chases protocol A because of the high yield until it collapses, losing all of their money. So over multiple years, sustainable 6% yield compounds into significant wealth over time, and volatility through a 40% APY or even 100% APY with periodic total losses completely destroys capital. So institutions think in decades, retail thinks in days or weeks. And the top institutions that our team has worked with, they prioritize three things. Number one is capital preservation. Protecting their downside matters more than maximizing their upside. Number two is sustainability. Yield sources that can maintain for years and beat these short-term spikes of these newer protocols to ensure that they play the long game. And number three is diversification. They never concentrate their risk in just one protocol, one strategy, or one asset. And I see a lot of retail investors coming to us that have like 90% or 100% of their income in something like XRP. And even though XRP is a legit blue chip cryptocurrency, that strategy is not what the institutions are doing. So this mindset shift that you're going to have in this video is the foundation here. We need to talk about the actual protocols now, because the top institutional yield strategies start with established protocols first that have years of operational history and multiple security audits. So let's talk about the lower risk protocols and what they offer. So some examples would be Aave and Compound. These are DeFi lending protocols where you deposit assets like USDC, Ethereum, or wrapped Bitcoin, and borrowers over collateralize loans and pay interest. And that interest gets directly distributed to the lenders. Now you can simply go to app.aave.com and you can see right here that current yields on Aave and Compound for stablecoins run roughly between 2 to 5% annually. Like right here for USDT, you can see 2.03%, USDC is 2.56%. Whereas if you scroll down here, you can see RLUSD is actually 4.17%. And the total reserve size is over $400 million, and the available liquidity is over $150 million. And the supply APY is over 4%, whereas the borrow APY is about 3.67%. And so the numbers you see on the screen right now suggest that RLUSD is rapidly becoming a heavy hitter in the DeFi lending space. And to put those numbers into perspective for you, here's what the data actually means for the asset's health and your portfolio strategy. Number one would be high institutional trust based on the total reserve size. A reserve of over $400 million with recent audits from firms like Deloitte suggests that total circulating supply has climbed over $1.3 billion for the market cap of RLUSD, and the volume over 24 hours is nearly $50 million. Now, that's down about 68%, but that's still absolutely massive, which indicates that RLUSD is no longer a niche experiment here, and it's a heavy hitter in the stablecoin space. And so if you look at the available liquidity here on Aave of over $150 million, that means that large players can enter or exit positions without causing slippage, which is price swings. And so RLUSD has seen a massive supply migration to Aave recently, and this suggests that holders aren't just sitting on the coin, they're using it as a productive collateral to earn yield or borrow other assets that they want. Now, number two would be the yield gap here. This is the supply APY of 4.17% versus the borrow APY of 3.67%. So in a normal world, banks and protocols are always charging borrowers more than they pay savers. That's how they make money. But with RLUSD right now, the math is actually upside down and the supply APY is larger than the borrow APY. And so why is this happening right now? Well, it's called a liquidity mining. Think of it like a grand opening sale. Ripple or the Aave DAO wants to make RLUSD the top dog stablecoin, so they're effectively subsidizing your return. And when you hover over the supply APY and you click this little icon right here, you can see the protocol APY is roughly 1% APY. That's the real market rate, whereas the other 3% is a bonus being paid out through a program called Merkle. They're literally paying you out to move your liquidity into their ecosystem. And the strategy here is called looping. It's a carry trade for the pro users. This basically creates what we call a carry trade or a looping opportunity because it's cheaper to borrow than it is to lend. So you could theoretically supply RLUSD, borrow against it at the lower 3.6% rate, and then redeposit that borrowed cash to stack your yield. So it's a classic move in a growing ecosystem where the house is footing the bill to attract new capital. So the bottom line here is this won't last forever. Once RLUSD hits its liquidity targets, those subsidies will dry up and the rates will flip back to normal. But right now, the grand opening, it's in full swing. And as of April of 2026, RLUSD has reached a circulating supply of roughly 1.37 billion. And big players like Deloitte are now providing the monthly audit. Now, number 3 is the market positioning standard yields on Aave or Compound. So if I go back here, you can see for USDT or USDC, it's around 2 to 3%, whereas RLUSD sits over 4%. So for you, this means that RLUSD is currently a competitive alternative to USDC or USDT for your dry powder or your cash reserves that are sitting in stablecoin. Now, obviously, RLUSD, it's not going away. It's part of Ripple's ecosystem, especially if you're looking for a regulated New York Department of Financial Services licensed option that still offers DeFi native returns. And for Ethereum or wrapped Bitcoin, yields are a little bit lower, where if you look at Ethereum right now, the supply APY is 1.64%, wrapped Ethereum is less than 0.01%. Wrapped Bitcoin is 0.01%. So Aave wouldn't be the best option for your altcoins. And currently Aave doesn't have anything for XRP. So hang tight towards the end of this video. I'll show you what you can do to earn passive income on your XRP. But the next platform is Lido.fi. This is liquid staking for Ethereum, where you stake Ethereum through Lido and you receive STETH, which is a liquid staking token that you can then use elsewhere while still earning staking rewards. And Lido currently fluctuates anywhere between 2.4% to 6% APY annually on staked Ethereum, depending on when you're watching this video. And the advantage is liquidity here. Your Ethereum earns staking rewards while you maintain the ability to use staked ETH in other DeFi protocols if you desire. And here's why these are lower risk. You know, Aave launched back in 2020 and Lido as well too. They have multiple security audits by top firms. They have billions in total value locked. They've been battle tested for their smart contracts, and institutional adoption and oversight watches these platforms closely. And as you can see right here, the total value locked on Lido is over $19 billion. So there's lower risk here. Now, lower risk doesn't mean zero risk. There's no such thing as zero risk anywhere on planet Earth. Anyone that ever tells you there's no risk with anything is lying to you. There's risk of breaking your ankle when you walk outside. There's risk of dying every single day. So it's not about getting zero risk. It's about mitigating your risk and having a diversification strategy like I told you about at the beginning of this video. So smart contract exploits, they're always possible, but the combination of time, audits, and track record makes these protocols the foundation of institutional yield portfolios. Now, the next tier includes protocols that are established but carry additional complexity or concentration risk. So it's important you understand these because these are medium risk tier protocols. So let's talk about Curve Finance, because if Aave is like the bank of DeFi, well, Curve is the trading floor. It's a decentralized exchange specifically designed for stablecoins. Because it's so effective at swapping stablecoins like RLUSD to USDC or USDT with almost zero slippage, it's where the big institutional volume lives. So when you provide liquidity here, you're earning from two sources. Number one is trading fees, where every time someone swaps in your pool, you get a cut. And number two is Curve rewards, or CRV rewards for short. This is where it gets very interesting here because Curve pays out its native token, CRV, to keep the lights on in the liquidity deep. Now, there's a few things that you can see here, like the base V APY, the rewards, plus Curve incentives. You can see the volume in the TVL, which is total value locked. Like this pool right here, if I scroll down, that says 3% to roughly 7.62%. So the 3% is your base rate, and you get this just for essentially showing up and adding liquidity, whereas the 7.62% is the max boost in Curve reward. So to hit that higher number, you have to lock up CRV tokens in their protocol for up to 4 years. Now, it's effectively a loyalty bonus where the more you commit to the ecosystem, the more they boost your daily earnings up to that max percentage so you can earn more in yield. Now, the pro tip is using Convex here, because if you don't want to lock your funds for 4 years, and let's be honest, in crypto, 4 years, it's an eternity. Most people use a booster like Convex Finance for this. They pool everyone's voting power together so you can get much closer to that max rate without the long-term lockup. And the bottom line is stablecoin pools on Curve are currently sitting between roughly 4 to 10%. You can even see RLUSD to USDC is about 5% here in RLUSD, which is much higher than you're going to earn on Coinbase or Binance. And you can see Curve USD to USDC is roughly 2% to 5.7%. And you obviously want to check the TVL, which is the total value locked. And you're going to see that the highest is DAI, USDC, USDT, and the second highest, over 100 million, is RLUSD to USDC. And then there's mixed pools where you pair a stablecoin with something like Ethereum, and they could jump as high as like 15 to 17%. You can see this pool goes from 7 to 17%. This one from 8 to 21%. This pool right here from 5 to 13%. This pool right here from 10 to 26. So they're all over the board. Now, using Curve requires you to be more active than Aave, but for the right strategy, the rewards are significantly higher if you want to dedicate some time to this. Now, if you want passive income, keep watching, because next is Convex Finance. Now, this protocol amplifies Curve yields by optimizing Curve rewards, where you deposit your Curve LP tokens into Convex and you receive boosted returns. Now, we'll explain more about this platform if you have any questions about it in a private training. So I'll show you how to get access to that. But the next protocol is Yearn Finance, and Yearn is a yield aggregator where it automatically moves your deposits between different DeFi protocols to maximize returns while managing gas fees and complexity. So it makes it much easier. And there's over $300 million deposited in Yearn vaults. Now, these are the medium risk protocols. And the reason why is because there's more complexity than just simply lending your crypto and earning passive income. And Curve involves liquidity pools with impermanent loss risks. Convex adds another layer of smart contract interaction. And Yearn's automated strategies can shift between protocols, introducing different variables there. So these protocols have strong track records. They're widely used by institutions, but they added complexity, and the dependencies carry more potential failure points than just straightforward lending on Aave or Compound. And institutions, they still use these protocols, but they size their positions smaller and they monitor them more actively so they don't take on more risk. Now, most people that will watch this video to this point, they will get overwhelmed and then they'll go back to just holding and hoping because they don't want to take on that complexity. So this is the exact moment and the reasons why the institutions win. So if your head is spinning right now, that's good. It means you're actually starting to understand how complex this is if you try to do everything by yourself and you don't know what you're doing. So the reality is most retail investors hear the word passive yield and they think it's as simple as clicking a button. But as you just saw, to get higher yield without locking your money away for 4 years, you have to understand the institutional plumbing underneath the surface. So this is exactly why we built the Altcoin Pro Accelerator program, because we realized that for most people with, let's say, $50,000 or more in crypto, the fear of making just a fat finger mistake or missing a yield window is the only thing keeping them from becoming their own bank. And you don't need to be a DeFi scientist here. You just need the blueprint and you need a coach that could help you set it up properly without worrying about not knowing enough to get started. Because if you don't know anything about what I'm talking about right now, that's completely fine. That's why we have coaches to help you out. So what I've done for you is I've left a link in the description below this video where you can book a one-on-one call with a yield expert on my team that tracks everything the institutions are doing to understand what's the safest, the most long-term, and the highest reward protocols that offer the highest APY for the lowest risk. And we've simplified it into an entire training video that you can watch in just a few minutes because we wanted to simplify this entire infrastructure and this blueprint for you. So we show you exactly what buttons to click, what protocols to avoid, how to automate this so you can stop staring at DeFi dashboards and wondering what to do, and you can actually start living off of the yield and turn it into something tangible. Because and before you go and take your earned income and buy something like $100,000 AP or a $50,000 or $60,000 Rolex, the smartest investors in the world, they use their yield, their passive income, to accumulate assets that will hold their value over time. So if you like collecting watches or you like collecting gold and silver, then the smartest move is to use the yield for that rather than your earned income. So look, we're not a call center. To maintain a high level of one-on-one support and quality, we only work with a small handful of serious investors each month that want to earn passive income from their idle crypto without having to figure everything out yourself. So if you're ready to stop holding and hoping and you want to start generating institutional grade cash flow with a percentage of your portfolio, then click the first link in the description, watch the short training video that simplifies this entire passive income system. And if it resonates with you, then book a strategy call with either me or an expert on my team, and we'll run through your current holdings and see if we can help you turn your idle crypto into a yield ready engine. So don't let the complexity stop you here. Let us help you become your own bank. Now, let me show you the higher risk strategies and why institutions avoid them so you can understand what to look out for to actually protect your capital as well. And instead of just telling you what to avoid here, I want to actually show you exactly how to find the high risk tier yourself using the same tool that my research team and our clients use every day, and one of them is DeFi Llama. Now, if you want to protect your capital like a professional, there's 3 specific filters that you need to look at before you even think about depositing a single dollar into a liquidity pool. Number 1 is the liquidity floor, and this is called the TVL, or total value locked. And so on DeFi Llama, on the left-hand side, you click on yields here, and you can see the pool, the project, the chain, and then the TVL. Now, if you hover over TVL, you'll see that it says it's available liquidity, which means supplied minus borrowed capital. And you can sort based on the TVL, and it'll bring up the largest total value locked pools. In this case, you'll see Lido, then Binance staked Ethereum, I believe, then Sky Lending, and then it goes down from there. You can see Aave up there too. Now, what I want you to do is to filter for a minimum of 100 million. By looking above where it says TVL range, click this drop down and type in 100 million, and then click apply filter, and it's going to filter out all of the lowest protocols, because if you sort by the lowest, you'll see 100 million is the bottom. Now, for core positions to earn yield from, what institutions look for is at least $1 billion or more. You can see the highest ones here, between 1 and 15, have at least $1 billion in total value locked. And the reason why here is because liquidity is your exit door. If a protocol only has, let's say, $1 million in it, but it offers you a 50% yield, for example, if I just clear that filter and I sort based on the lowest TVL, you can see this one right here has 42% APY, but the total value locked is just $10,000. And it's off of a pool, off of some random meme coin called Chippy versus Wrap Soul that no one's heard of. So the moment that a whale decides to leave that coin, well, the pool collapses and you'll be left with paper gains that you can't actually swap back for cash. Whereas high total value locked, when you sort based on the largest protocols, means the smart money has already vetted the door here. So number 2 is the yield to TVL ratio. Now look at this. When you sort by APY with your 100 million minimum total value locked range filter applied, you'll see the highest APY, then you click it again, it will go to the lowest APY. So because you have this filter on, you're going to see that the highest APY is 13%. If you have the TVL filter off, you're going to notice that when you sort based on the highest APY, you're going to see these crazy 5 or 6 digit APY numbers here because they're off some low liquidity and low total value locked meme coin. But notice the TVL on these higher APY numbers is really small. So in the institutional world, what we look for is sustainable yield. Basically meaning if the APY is 50%, but the TVL is only at like $500,000, that's what we call an incentive trap, because they're incentivizing you with a higher APY, but they're trapping you with lower total value lock. So a whale could come and just completely pull out. So the yield isn't coming from real revenue like trading fees or interest. It's coming from token emissions. Basically, the protocol is printing its own money to pay you out. So as soon as people start selling those rewards, the token price tanks, and your 50% yield, or in this case, you can see, 250,000 to 950,000% yield turns into a -20, -50, sometimes -90 or -99% loss on your principal. Now, number 3 is the deep dive security check. So don't just take a dashboard's word for it based on total value locked. What a sovereign wealth architect goes straight to is the source to look for the audits. So there's a couple ways to do this. Number 1, you can simply click on the pool right here and it'll pull up the entire pool. In this case, it's Lido Ethereum, and you can scroll all the way down to the bottom and you'll see the protocol information like the category, and you can see the audits, and you can see if it says yes or no. So when I click on this, I can go to the GitHub and I can see all of the audits here. So this is a list of all the complex reports. If you want to see the finalized audits from all of the heavy hitters like Certic, Trailbits, Open Zeppelin, Peck Shield. Now you need to know exactly what to look for because, for example, here, this is a 17-page document here, and it shows you the impact and the vulnerability of the certain protocol or the pool. So if it feels a bit overwhelming, you don't know exactly what to look for to vet these projects, that's good. It just basically means that you're starting to understand how all of this works and you realize how much there is to it. So here's the reality. By the time that you watch this video, 1 month from now, maybe 2 months from now, even 24 to 48 hours from right now, there's going to be new pools popping up that I can't cover or show in this video. And so the assets change and the yields shift all the time, which is exactly why we built the Altcoin Pro Accelerator program. So if you're a client, you don't have to guess if a new pool is audited or not, or if it's a yield trap. You don't have to spend hours dipping through footers for PDFs or reading the audit reports here. You just simply reach out to your designated coach in your private Slack channel 24/7 because they live and they breathe this infrastructure every single day. You simply drop the link of any project, any protocol, even any altcoin that you want them to check out, and they look under the hood, and then they give you the institutional verdict at any time of the day. So you get a handheld experience for all of your questions. So if you aren't a client yet, but you're tired of the trial and error method with your portfolio and you want to know which projects you're looking at are legit versus which ones are just going to scam you and take all of your money, then just click the link below, watch the training, book your call, and we'll make sure you never have to navigate the crypto world alone. Because if a protocol is institutional grade, they won't hide these audits. They'll have 5, 10, or even 20 different audits for every version of their code. And if you can't find a direct link to a third-party securities firm report in the footer, well, that's a massive red flag, because institutions don't deposit millions into just a black box here. They read the inspection reports first. If there's no report, there's no deposit. It's that simple. That's one of the main core steps that has to pass before they even put any capital to it. Now, on DeFi Llama, what you can actually do, you can filter by attributes here, and you can simply select the audited tab here, and it'll only select pools from audited projects only. So when you have the minimum total value locked of 100 million, the audited attribute selected. If a project is, let's say, less than 6 months old or has 0 audits, well, it's not an investment, it's a gamble. So institutions require, at least 2 independent audits and a minimum of 6 months of battle-tested history before they move significant capital into them. So the goal here isn't to chase the highest number of APY here, it's to find the highest risk-adjusted number. So if you see a pool on Aave paying, let's say 4% on your stablecoins that's backed by billions of dollars in total value locked in years of audits, well, that's legit. If you see a new farm paying 40%, but it fails all 3 of these tests, then run, because institutions, they stay rich by avoiding the 40, 50, 100, 200% traps. Now, there are times where you can earn that yield. It's possible. There's protocols paying them, although it's not a guarantee, but that's a portion of your portfolio that is for higher risk yield strategy. So that's the sovereign mindset there. Now, let's talk about how much of your total crypto holdings should be allocated to yield generation, because institutions, they don't put 100% of their crypto into yield protocols. They maintain liquidity buffers and core holdings outside of smart contracts that could potentially get exploited. Like I said, it's not about zero risk. It's just about managing the risk that's there. So here's 3 allocation frameworks for example purposes only. Obviously, this is not financial advice, and these videos are purely for educational purposes only, because that crypto is risky. You can lose all of your money in this industry if you don't know what you're doing and you don't have a coach. So let's talk about the conservative allocation first, and that's roughly 20 to 30%, and roughly 70 to 80% of your crypto stays in cold storage or security wallets, earning no yield, but fully under your control. Because 20 or 30% goes into yield generation across lower risk protocols like Aave, Compound, or Lido, and this allocation prioritizes security here. You're earning yield on a portion while maintaining control over the majority of your crypto. And if all DeFi protocols, let's say, experience issues simultaneously, well, 70 to 80% of your holdings remain safe. Now, if we talk about a moderate allocation, that's roughly 30 to 50%, whereas 50 to 70% stays in cold storage, and 30 to 50% is in yield generation, split between lower risk and medium risk protocols. That's maybe 20 to 30% in Aave and Compound, and then 10 to 20% in Curve or Convex. And this balances yield optimization with security. So you're generating meaningful income while maintaining substantial holdings outside of smart contract risk. And then the aggressive allocation strategy is 50 to 70%, and then 30 to 50% in cold storage, whereas 50 to 70% is generating yield and is diversified across lower risk, medium risk, and potentially a small allocation to higher risk protocols. So what this does is this maximizes income generation, but concentrates risk in smart contracts, and it's only appropriate for investors who fully understand the risk and can afford potential losses, because they're not just hung up on one protocol here. And most institutions managing client capital use conservative to moderate allocations, 20 to 40% in yield, and that's 60 to 80% in secure custody long term. So they're prioritizing capital preservation over maximizing yield. But if you're not an institution, then you might have a higher risk tolerance. So that's why you need to talk with our coaches to tailor a specific strategy to your current situation and your risk tolerance. And when you choose your allocation based on your risk tolerance, you need to remember this. Institutions, they prioritize protecting their downside first before maximizing their upside, because rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Now, within your yield allocation, diversification across multiple protocols it's super critical here because institutions, they're not just putting all of their yield and all of their capital in just one protocol to earn yield. Even if it's Aave or Compound, they split across 4 to 5 different platforms to minimize a single point of failure and risk. So let's say you're allocating 40% of your total crypto to yield generation during a bear market. And within that 40%, here's an example split. 30% could be to Aave for stablecoin lending, 25% to Compound for, let's say, Ethereum lending, and then 20% to Lido for liquid staking. Then that leaves 15% to Curve stablecoin pools, 10% to Convex for boosted Curve yields. And then this diversification means if one protocol experiences an exploit or any issues, you lose at most 10 to 30% of your yield allocation, which is a small fraction of your overall strategy. You're not losing 100%. And so this diversification also smooths the yield fluctuations because when Aave rates drop, Curve might be paying more. Then when staking rewards decline, lending rates might actually increase. So spreading across multiple sources stabilizes your overall income and also preserves your capital. Now, let's talk about rebalancing rules. So what you need to do is ultimately just show up for the calls that our coaches run every single week, and they'll explain the best strategies, but it's important for you to be able to check allocations quarterly, of course. If one protocol's portion grows beyond your target due to yield accumulation, then you simply rebalance your portfolio because a lot of spot positions might go down in a bear market and you might be earning more through yield than you would be just holding spot. So it makes more sense to be earning yield at certain times in the market, like a bear market where you're earning more in stablecoin yield. So what the top institutions that we talk with are doing is they're monitoring constantly and they're rebalancing regularly. So this isn't a just set it and forget it forever strategy. It's active management with predetermined rules. However, if you want a set it and forget it strategy where you just check it like 5 to 10 minutes a week because you have a full-time job, you got a career, you got a family, we can actually show you how to do that as well. And yes, the yield isn't going to be as high as managing it more, but you can still earn more in passive yield that these protocols pay off of Coinbase or Binance when you just know where to look. So next, let's briefly cover tax implications. Now, I'm not a tax professional and rules are obviously going to vary by jurisdiction, so always consult a CPA, but here are the basics that institutions consider. That's yield as taxable income, because in most jurisdictions, yield earned from staking, lending, or liquidity provision is treated as taxable income when received. So for example, if you earn, let's say $100 in USDC yield from Aave, well, that's $100 of taxable income in the year that you receive it. And when you later sell that USDC, you may also trigger capital gains or losses depending on any price changes. Because USDC tries to stay pegged to $1, sometimes it's worth $1.03. Sometimes it's worth 97 cents. So it depends on when you're selling it too and how much you're selling. And the initial yield receipt is income. So the subsequent sale is a capital event, either short-term or long-term capital gains tax. Now, here's how the institutions structure their taxes. Institutions often use tax advantages or entities or different jurisdictions to optimize how they get treated. So they track every transaction meticulously. They harvest losses strategically on their spot, and then they consider holding periods for long-term value versus short-term capital gains treatment. Now, if you're an institutional investor, we do have tax professionals that are very, very familiar with crypto. In fact, they deal mostly with crypto. They deal with people that make over, $10 million a year, 100 million, even billionaires. And they deal with people who are just starting out as well too. So if you need a CPA or you need a tax planner that's certified, because obviously I'm not certified, so I'm not providing tax advice here, but I can point you in the right direction, feel free to simply just book a call through the link below. When you jump on a call with either myself or an expert on my team, we will connect you with one of our top CPAs that actually does our taxes to help you with everything from tracking all of the yield you receive to all of your day trades, all of your swing trades, if you're applying our technical analysis training, so you can rest easy at night. Because the last thing that you want here is to let tax season surprise you with a massive bill from the yield that you're going to be earning on the liquidity pools that you're putting capital towards. And then if you spend that yield or if you spend your day trading income on luxury goods, the worst thing is having the IRS knocking on your door because you don't know how to report your gains and losses from crypto because you went with an illiterate CPA that knows nothing about crypto. So tax-aware structuring is part of the institutional blueprint. It's not about avoiding taxes, it's about understanding obligations and optimizing legally using strategies that the wealthy use to minimize your taxes. And that's what our CPA specializes in. So I'm not a CPA, obviously, but I got the best of the best for you guys. So check it out through the link below. Jump on a call with our team. We'll point you in the right direction, because whether you're holding Ethereum, Bitcoin, XRP, or stable coins like RLUSD, USDT, USDC, or other assets, your portfolio is structured to produce sustainable yield while managing your downside risk. So click the link below, watch the free training. If it makes sense, then book a call with either myself or my team. And as always, I will see you at the top. If you got value out of this video, make sure you subscribe and let me know what cryptocurrency you're the most bullish on by commenting it below. I will see you on the next video. You know what to do.